Where does that put silver today? I mean, even at a suppressed $30 spot price, let's just pick the number, round number, that'd be $275. I mean, in round numbers. I mean, why not? Why would it not be?
Because there's been a concerted effort for 100 years to suppress the price of silver. Actually, you could go back to, I think it was 1897 in the U.S. when there was the big fight between the East Coast, the gold people, and the Western markets that were digging up a lot of silver. I mean, it goes back 125, 130 years, the price suppression. At this point, think about the uses of silver. I mean, there's so many uses. There's industrial uses, there's technological uses, there's medicinal uses, and now we've got the green energy uses. So there's so many more uses for silver, and there's almost no uses for gold other than jewelry and reserves, bank reserves, or individuals holding it. So there's so many uses for silver. What if you woke up tomorrow morning and silver was $200? What would happen to a lot of the products, a lot of the uses that are in place right now? What would happen to those? Some of those, probably many, maybe more than half, those uses, the model wouldn't make sense. I mean, that would bleed through to the entire system, where you would see an inflation of all sorts of goods in all the uses for silver. Would that upset the whole system? I don't know, but I know it would certainly upset a lot of industries. I would just go back to 1929, 1930. What happened then? Tariffs were raised all over the world. What happened? Trade collapsed. And that's what's going to happen here. If he does go through with these tariffs, and when I first heard it right off the bat, I'm like, that's not really a great idea, because that is going to harm trade. Trade is what creates, if you want to call it, velocity worldwide. It creates, money moves. It creates liquidity. You put some sand in those gears and you're going to have a hard time getting the machine going again.
Yeah, that makes, it does make sense. And so, I mean, and yet, what as the threat of these tariffs or sanctions, or whatever you want to call them, is what is driving the acceleration of BRICS central banks, BRICS facing central banks, to purchase more gold. Because again, for just the reason you've outlined, it underscores the very reason that you've just outlined.
Well, yeah, and I kind of want to go back to what we were just talking about. Everything in the world, and I'm not talking about physical assets, I'm talking about financial assets. Everything in the world has the possibility of bankrupting. Gold and silver cannot bankrupt, thus making them the perfect foundation, the last two financial men standing, when this thing comes down.
When we look back at history, we see that economic collapses have been driven by government policies, reckless monetary expansion, and the inevitable consequences of unsustainable debt. The 1929 Great Depression is one of the most glaring examples, where a cycle of excessive credit, market speculation, and misguided government intervention led to a financial catastrophe. Now in 2025, we are staring at a situation that has all the warning signs of repeating history, but on a much larger scale. The modern-day global economy, with its reliance on fiat currencies, unchecked money printing, and towering debt levels, is set up for a financial disaster unlike anything we have seen before. One of the primary catalysts that could accelerate this collapse is the introduction of tariffs by the United States, particularly against BRICS nations. Former President Donald Trump, who has signaled his intention to impose 100% tariffs on BRICS nations, is essentially engaging in economic warfare. Let's be clear, tariffs are not just about protecting domestic manufacturing. They are, in this case, sanctions disguised as economic policy. The idea that foreign producers will simply absorb the cost of these tariffs is a fantasy. In reality, tariffs result in higher prices for consumers, disrupted supply chains, and retaliation from trading partners. History has taught us this lesson before. During the 1930s, the Smoot-Hawley Tariff Act was passed under the false assumption that it would protect American jobs and businesses. Instead, it led to a devastating trade war, with countries around the world retaliating by imposing their own tariffs. Global trade collapsed, deepening the Great Depression. When trade slows, economies shrink, and financial markets unravel. The same pattern is set to repeat, except this time the global economy is far more interconnected. China, India, Russia, and other BRICS nations are not dependent on the US the way the world was in the 1930s. They have built alternative trade alliances, stockpiled gold, and taken steps to move away from the US dollar as their primary trade settlement currency. This brings us to the core issue, gold and silver as the last two financial assets standing. Unlike fiat currencies, which can be printed into oblivion, gold and silver cannot be defaulted on. Governments and central banks can manipulate interest rates, create artificial stock market booms, and print trillions of dollars, but they cannot create gold and silver out of thin air. The fact that central banks have been buying gold at record levels, particularly China, Russia, and India, is a clear sign that these nations are preparing for a post-dollar world. China, for example, has been quietly accumulating gold through the People's Liberation Army and purchasing directly from miners in Africa, South America, and beyond. It has intentionally avoided reporting its true gold reserves to the IMF, keeping actual figures 10 times understated. Meanwhile, Saudi Arabia has been caught importing gold without reporting it, an unmistakable sign that even traditional US allies are hedging against the collapse of the dollar-based system. Now let's think about the psychology of the markets. Gold is often viewed as an asset people flock to in times of crisis. However, unlike previous economic downturns where gold was treated as a speculative asset, this time it is being seen as a necessity. BRICS nations understand this. They know that treasuries can be defaulted on, currencies can be devalued overnight, and stock markets can crash, but gold and silver retain their value. The West, particularly the US, is behind the curve. We are watching the collapse of fiat in real time, yet most investors are still blindly holding on to paper assets. One of the biggest financial mistakes people are making today is thinking that gold and silver are just another commodity. They are not. They are money. Central banks know it, billionaires know it, and now increasingly, average people are waking up to it. But the moment the general public truly understands that it is not gold going up in price, but rather fiat currency losing purchasing power, it will be too late. The scramble to accumulate physical gold and silver will send prices soaring, making them unattainable for most people. The signs of this shift are already visible. Gold has had one of its best years in 2024, rising over 25% despite a global economic slowdown. Yet gold mining stocks have been underperforming, largely due to market manipulation and mispricing. This is temporary. Eventually, reality will set in, and there will be a mass movement out of stocks, bonds, and fiat, and into tangible assets like gold, silver, and strategic commodities.
Like I said, creating tariffs, you got to be really careful, because then you could create a tariff war / trade war.
Yeah.
And, trade slows down. China is super leveraged. We're super leveraged. All you have to do is knock one of the wheels off the track, and the rest are going to follow. And I think that's tariffs, the way they're being explained to the American people, that they're a good thing and you won't have to pay as much in taxes because foreigners are going to be paying the taxes. Well, what tariffs are going to do is when you slap a tariff on something, you're going to get less supply of it because some suppliers are not going to send it. So now you've got less supply, which that on its own raises the price. But if you add 10% or 25% or 50%, whatever, to the widget that you're making, that money is going to ultimately be passed along to the consumer. So something that cost $10 yesterday, and then they put the tariffs on, it might be $13, $14. You're feeding the inflation monster, and you feed, I guess most importantly, you feed inflation expectations. And what that leads to is people basically just trying to spend their currency before it goes further down in value. The realization that world trade was something for nothing, the U.S. would import real goods and export dollars, which are nothing. That's the reason, or one of the main reasons behind the formation of the BRICS in the first place. I mean, that's why they've joined together. They want free and fair settlement. And fair settlement is not where you give goods and you get a piece of paper that, continually day after day loses value because they're printing more of it every day. The treasuries, the currency of treasuries can and is being diluted. The danger of not being paid back, an outright default, is rising, although I don't think that'll happen because they can always print. But there is that danger. And on top of that, then there's the danger that the U.S. Treasury will decide, we don't like what you're doing. Your money is now ours, like what they did with Russia. So I think the Keynesian thought process is flawed from the respect of they don't understand what's the true foundation to the financial world. It's gold. It's not treasury bonds. Although for the time being, it is treasury bonds. But there's going to be a comeuppance that the likes that the world collectively has never seen before.
As we look ahead to the unfolding financial landscape in 2025, it is becoming increasingly clear that the global monetary system is at a turning point. The accumulation of gold by central banks, the de-dollarization efforts by major economies, and the shifting tides of geopolitical power all signal a fundamental restructuring of the financial order. The decline of fiat currencies is inevitable, and with that decline, gold and silver are set to assume their historical role as real money. One of the most overlooked aspects of this shift is the impact of debt. Global debt has reached astronomical levels, with the United States alone burdened by over $34 trillion in national debt. This is unsustainable. Governments have borrowed excessively under the assumption that they could indefinitely manipulate interest rates to service their obligations. However, as bond markets signal distress and real interest rates rise, the illusion of debt sustainability is beginning to crumble. Inflation, rather than being a temporary phenomenon, has become embedded in the economic structure. The idea that the Federal Reserve or any central bank can navigate this storm without significant consequences is nothing short of a fantasy. The primary reason why gold and silver remain undervalued relative to the financial crisis unfolding before our eyes is due to the deep-seated manipulation of these markets. Western governments and their central banks have a vested interest in suppressing gold prices to maintain confidence in their failing fiat currencies. This is done through complex mechanisms such as paper derivatives, unallocated gold trading, and leasing agreements that create an artificial supply of gold. However, these manipulations cannot last forever. As confidence in the US dollar wanes and global investors seek safety, the physical demand for gold will overwhelm the paper markets, forcing a dramatic upward repricing. Silver, often called gold's volatile cousin, is also primed for a historic revaluation. The gold-to-silver ratio remains abnormally high, hovering around 80-1, when historically it has been closer to 16-1. This is an anomaly that will correct itself as the financial crisis deepens. Silver, with its industrial demand in green energy, solar panels, and electronics, will see an additional surge in demand even beyond its monetary attributes. The actions of central banks provide the strongest confirmation that gold's role in the financial system is being restored. In 2023, central banks purchased over 1,100 metric tons of gold, the highest annual total on record. China, Russia, Turkey, India, and even Middle Eastern nations have been aggressively adding to their reserves. What does this tell us? It tells us that the institutions responsible for managing national economies see a future where the current financial system cannot be sustained. It is worth asking, why are these central banks not buying U.S. treasuries as they did in the past? The answer is simple. They no longer trust the U.S. government to maintain the value of its own currency. The endless money printing, reckless spending, and weaponization of the dollar have led many nations to seek alternatives. BRICS nations in particular have been diversifying away from the dollar by establishing bilateral trade agreements that bypass the U.S. financial system altogether. The BRICS bloc, Brazil, Russia, India, China, and South Africa, is at the forefront of the de-dollarization movement. What started as an economic alliance is now evolving into a geopolitical force that is actively working to undermine the dominance of the US dollar. One of the most significant developments in 2024 was the expansion of BRICS to include Saudi Arabia, Iran, the United Arab Emirates, Egypt, and Ethiopia. This expansion is particularly critical because it brings major oil-producing nations into the fold, setting the stage for an alternative oil trade system that does not rely on the petrodollar. At the heart of the BRICS strategy is the move toward a gold-backed trade settlement system. Russia and China have been vocal about their desire to create a currency alternative that is not subject to the manipulation and inflationary policies of the U.S. Federal Reserve. While a fully functional BRICS currency may still be years away, the groundwork is already being laid through digital payment systems, blockchain technology, and gold reserves. Now let's talk about one of the most overlooked opportunities in the current market: mining stocks. The disconnect between the price of gold and silver and the valuation of mining companies has never been wider. Gold prices have risen significantly, yet mining stocks remain stagnant or even depressed. The reason? Institutional investors have largely ignored the sector, opting instead for speculative assets like technology stocks, cryptocurrencies, and other high-risk instruments. This is a mistake. If we look at historical cycles, mining stocks tend to lag behind physical gold prices during the early stages of a bull market, but eventually catch up in dramatic fashion. When institutional capital starts flowing back into the sector, valuations will skyrocket. We saw this happen in the 1970s, and we are likely to see it again in the coming years. The best mining companies, those with strong balance sheets, high-grade reserves, and efficient management, will benefit the most. Silver, often referred to as gold's volatile cousin, is particularly interesting right now. The gold-to-silver ratio, currently hovering around 80-1, suggests that silver is severely undervalued. Historically, this ratio has tended to revert to around 40-1 or lower during precious metal bull markets, meaning that silver has the potential to outperform gold in percentage terms. Looking ahead, we should expect more central banks to continue diversifying away from the US dollar and into gold. The geopolitical landscape is shifting, and with it, the financial system is undergoing a transformation. The days of the US dollar as the undisputed global reserve currency are coming to an end. While this transition will not happen overnight, the signs are already there. Investors should prepare accordingly. That means increasing exposure to gold and silver, not just as speculative trades, but as core holdings. It means looking at mining stocks as an undervalued sector with significant upside potential. And most importantly, it means understanding that we are entering a period where financial repression will become the norm. Governments will try to inflate their way out of debt, and those who fail to hedge against currency debasement will suffer the consequences. As we close out this discussion, I urge everyone to consider the broader implications of what is happening in the global economy. Gold is not just another asset class. It is the bedrock of financial stability. While Western central banks may continue their short-sighted policies of monetary expansion, the rest of the world is preparing for something different. The BRICS nations, along with other emerging economies, are setting the stage for a new financial order, one where gold plays a central role. If you're still holding on to the illusion that fiat currencies will maintain their purchasing power indefinitely, think again. History has shown us that all fiat currencies eventually return to their intrinsic value, zero. Gold and silver, on the other hand, have endured through centuries of economic turmoil, wars, and political upheavals. They remain the ultimate hedge against uncertainty, and in the years to come, they will prove their worth once again. The question is, will you be prepared, or will you be caught off guard when the next crisis hits? To those watching this, consider this a wake-up call. If you haven't already, start diversifying your portfolio. Buy physical gold and silver. Look into mining stocks. Educate yourself on the fundamentals of sound money, because when the next financial crisis unfolds, it won't be the central banks or the politicians who save you. It will be your own foresight and willingness to take action. As Alasdair MacLeod often says, gold is not about making money, it's about preserving wealth. And in the world we are heading into, wealth preservation will be more important than ever. Stay informed, stay prepared, and most importantly, stay ahead of the curve.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.